Hello and welcome to the Portfolio Matters Share Talk, 14th of January 2021, where I'm going to be explaining to Keith why I think Ely Gold Royalties is an interesting company. But before I do that, it's over to Keith for the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor for making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Keith. So Ely Gold Royalties has a market cap of £98 million. It's quoted in Canada, so 170 million Canadian dollars. It is an early stage royalty company. It has a possible period of 3 or 4 years of enhanced and substantial growth in revenues and share price. It's a leverage play to any increment in gold price increase. And it is less volatile than gold mining shares. So what is a gold royalty?
Richard, you just said you have some of this, do you?
I do, yes. Currently showing a loss.
Oh, good. It's time to buy.
So, yes, yeah. Please, Keith, buy lots. So, what is a gold royalty company? So, building a gold mine is expensive, takes a lot of capital, and the traditional way to finance a gold mine is through either borrowing money or issuing equity. And both of these routes can be problematic and restrictive. They can be expensive, and they can also simply not be available. Royalty companies step in and provide funding to miners in exchange for a share of future production revenues, a royalty. And they're relatively recent, so the first royalty company came into existence in around 2004. So the share of production or royalty might be a percentage of gold production which the royalty company has the right to buy at a predetermined price. For example, $1,100. A streaming contract, as it's known. And this makes up about 75% of all royalty deals. While a mining company may sell its gold directly into the market and then pay the royalty company a percentage of the revenue or profit, which is called a royalty deal. So the royalty company has a supply of gold from the mining output at a predetermined price that it pays. So they can make money even if the price of gold is falling. They don't operate mines themselves. They have no infrastructure costs and just a small administrative operating cost. And they can pick and choose their projects in order to hold a diversified portfolio to spread their risk.
This is really interesting, Richard, because I've actually owned some companies on the other side of these contracts.
Right.
So one that particularly comes to mind is I own this Ecuadorian explorer, actually it's a London-listed company that's exploring in Ecuador called Sol Gold.
Right.
I found these enormous copper gold deposits.
Yeah.
And they have signed one of these. And it's a streaming contract.
Yeah.
And I honestly, I kind of didn't really understand how it worked. And
do you know
so this is really interesting.
Do you know who it's with?
No, I do. I don't. I should look it up. But I think what of relevance is the fact that these mines are actually years away. So, you know, they're currently studying that they've got a streaming contract for the drilling of the exploration wells to prove the resource.
Yeah.
And they still have quite a long way to go before the mine is built. So this contract, you know, might only see money coming back to the royalty company in 6 or 7 years' time.
So as I get on to it a little bit later on, this is a long-term investment. You're quite right, Keith. So the business model is the acquisition, consolidation, enhancement, and resale of precious metals properties while retaining a royalty interest. It has a portfolio of properties that produce recurring cash flow from the mineral property options. And the properties are located in a geographically, politically stable region of the Western United States with a focus on projects in Nevada I just laugh slightly with the recent events in Washington, but nevertheless, I think that the USA is politically stable. So royalty companies' share prices have performed much better than the prices of gold miners. So if you look at comparison 10 years ago when gold was $1,350 an ounce, and it's now 40% or so higher, the index of gold miners is about 40% lower than it was 10 years ago. The largest royalty company, Franco-Nevada, is up over 4 times. And there are a number of royalty companies to choose from if you wish to invest in this area. And this table comes from Ely Gold's corporate website in a presentation they prepared last December 2020. So we have a list of 9 royalty companies, all of which I think are quoted, and then we have Ely Gold at the bottom. And I think the thing to notice is the share price and then the net asset value per share. So Franco-Nevada, net asset value per share is 50% of the share price. Same for Royalty Gold, Wheaton. 1-to-1 for a Cisco, 2-to-1 for Sandstorm. But Ely Gold Royalties, the net asset value per share is less than the price per share. Sorry, greater than the price per share. So it is effectively trading at a discount of 30%. And so part of the investment proposition is to see this discount move from where it is now to something that appears to be a more normal sort of ratio in the
Richard, can I just ask, so has Ely Gold only recently moved into this space? Are these, so it's previously signed contracts, its first contracts that are only now coming good?
Yes.
And so what part of the value proposition is that this is less recognized than some of the bigger, more established companies?
Yes, so as you can see from here, it has pretty small anticipated revenues for 2020, but they're growing quite quickly over the following years as they expect that their production, the companies that they have royalties with, move into production. And as they move into production, the royalty revenue increases very significantly, but there is a long delay period. So this is the graph of their share price, where basically it did nothing for a long time, and then it's kicked up to, and it's now dropped significantly from that point. I purchased mine around about here, I think. Actually, it's a reasonably significant drawdown on that.
Yeah.
This is the share price of Ely Gold compared with the GDX in light blue down here, and the GLD, the gold. So the GDX is the gold miners ETF, the GLD is the gold ETF. So you can see that the share price has jumped substantially above, moved substantially above the movement of these comparators.
Well, I would say it seems to be highly geared. So, you know, it peaks at a similar time to the gold price, but then as the gold price comes down, it comes down further, which is, you know, if it's geared to it, exactly what you'd expect.
Yeah.
Can I just ask, Richard, these streaming contracts, are they a percentage of mine production, or are they a fixed quantity that they get from a particular mine? So the question is, do they participate?
I understand the question. I think they will. I think each contract clearly will be different, and I've never read a royalty contract, but I would imagine that they will certainly go up to a fairly significant level of production. I mean, the funding will be based on whatever the expected production of the mine would be. And I can't see the royalty company not wanting to get its full quota of anticipated production at the time it enters into that agreement.
Right.
It may be that the mine at a certain point needs additional funding to expand its production capacity, and I believe then it would go into another royalty contract. So yes, they will be geared into incremental production. I would say up to the point at which the contract foresaw that the funding could actually develop that production. And of course, if production continues for many years, the royalty stream continues for many years.
Yes.
So it's a little bit like having an annuity once production starts, a stream of annuities. So if you compare what a couple of the larger royalty companies have done in terms of their performance, again, this is off the Ely Gold Royalties website, but the Royal Gold went up 32 times in its first 4 years, Franco-Nevada 37 times in its first 4 years. And in its first year, Ely Gold has gone up 4.5 times. So the question here is, if Ely Gold were to replicate over the next 3 or 4 years the share price movements in these two, as their royalty streams start to come in and they start to be recognized as a cash flow positive business, is the share price of Ely Gold going to move up in the manner that these two did? If it does, there's a significant upside. So that's one of the. So there's just a couple of kickers there, aren't there? There's a difference in net asset value, and there's the effect of the kicking in of the production, of the actual production of the companies that they're funding, elevating their cash flow, and therefore raising the share price, which is presumably what's going on here. And here, production is starting to kick in. The cash flows are starting to rise dramatically.
Well, before you move on, these charts are absolutely extraordinary, because the gold price had an extended bear market between like 2011 and 2015. It fell a third. And,
you
know, these share prices just keep on marching higher.
Yes, that's true, Keith. And there's
amazing. So,
because effectively their cash flow stream is far less sensitive to the cost of the margin, the mining margin.
Yeah, no, I understand that, but they still are exposed to the gold price. If you're buying the gold, you have an agreement to buy, 10,000 ounces or whatever, 5% of the mine output at $1,000 an ounce. Your revenue is still determined by the gold price.
Yes.
So the fact that when the gold price fell a third, the share price still went up, I find amazing.
I presume that in the business models of all of these businesses, they are continually adding royalty streams.
Well, that must be it.
So
that must be it.
Yeah, so there's a continuing improvement in their cash flows. So this is what they've said they've achieved in 2019, their goals for 2020. So they've added 17 royalties in 2020. They do trade in properties. They have strengthened their capital structure. They've actually raised a substantial sum of money in 2020. And they're looking for profitability in 2021.
Great. And I noticed they've got the gold conspiracy theorists right at the top of their capital.
Oh, yes.
Shareholders.
Rick Rule and Eric Sprott.
Rick Rule and Eric Sprott. Yes.
Both very rich individuals.
The end of the world.
Both very rich individuals, it has to be said. And then the last slide is just a financial summary. The main thing I think to look at here is the cash balance, which is with the fundraising in the summer of 2020, have a very significant cash balance. So there we are, Keith.
Well, thank you, Richard. I think that's really interesting. I mean, my concern would be that, it's got 12 million of cash, but it's got a market cap of 170 million. So you're talking of a net market cap or enterprise value of 157 million. but those charts basically showed royalties in 3 years' time of 16 million. So really, in order for this company to be a value play, you have to assume that the kind of growth you saw on that chart continues. And when you said in the last slide that it signed 16 royalty agreements this year, then clearly there is a lot that will come on in later years. And
Yeah.
I mean, it's certainly something that is very interesting and merits further research.
So I think it's one of these companies you invest in for 5 or 10 years, Keith.
Right.
And you invest in it because effectively it is going to be a cash cow.
Right.
And when it becomes a cash cow, it will pay ever increasing dividends, and the
Right.
share price will march up accordingly. So I think that is the investment thesis for this company. It's not buy it now in the hope that the price of gold goes up by $200, make it, and then sell it at a quick for a quick profit.
Right. No, very interesting. And I get the chance to get in at a cheaper price than you did. So.
Yeah, absolutely. You will always be ahead if you, no matter what. It's inevitable.
Marvelous. Well, that alone is
like
to do something.
Good.
Right. Well, great. Thank you, Richard.
Welcome. Pleasure. Pleasure. So now it's just the time to say goodbye.
Yes. Press like.
Yeah.
Subscribe to the channel, please. Join us for a few more of these and send us your comments at info@portfolio.matters.co.uk.
Great. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.